In 2008, millions of people lost homes, jobs, and savings, while major banks reported record recoveries just a few years later. This paradox raises a deeper question about how financial systems distribute risk and reward. The modern banking system is built on a structure where profit is privatized, while risk is often socialized. When the system expands, banks capture gains, but when it contracts, losses frequently spill into the broader economy. At the center of this mechanism is credit creation, a process that allows banks to lend far more money than they physically hold. This system, known as fractional reserve banking, turns debt into a primary engine of economic growth. When banks issue loans, they effectively create new money, increasing the total money supply in circulation. This expansion fuels asset prices, consumption, and economic activity, but it also builds systemic fragility over time. The more credit expands, the more dependent the economy becomes on continued borrowing. If that borrowing slows or reverses, the system begins to contract, often violently. This pattern has repeated across centuries, from early banking crises in Europe to modern financial collapses. Each time, the structure remains largely unchanged, even as regulations evolve. One of the earliest documented examples occurred during the Dutch tulip mania of the 1630s. Credit expansion allowed speculative prices to surge before collapsing abruptly. In that period, tulip contracts were traded with borrowed money, inflating prices beyond any intrinsic value. When confidence broke, the entire market collapsed, wiping out fortunes overnight. The same credit-driven dynamics reappeared during the South Sea bubble in 1720. Investors borrowed heavily to buy shares, expecting perpetual price increases. When reality failed to match expectations, the bubble burst, leading to widespread financial ruin. Banks and elites, however, often exited earlier or were protected by policy interventions. By the 19th century, banking systems had grown more complex but retained the same underlying vulnerabilities. The Panic of 1873 marked a major global financial crisis, triggered by excessive railroad speculation and debt. Banks had extended massive loans to finance infrastructure projects that failed to generate expected returns. When defaults began, confidence evaporated and a prolonged economic depression followed. The early 20th century introduced central banks as stabilizing institutions designed to manage crises. The establishment of the Federal Reserve in 1913 aimed to provide liquidity during financial stress. However, the system did not eliminate cycles, as seen during the Great Depression beginning in 1929. Massive credit contraction led to bank failures, unemployment, and deflation. Between 1929 and 1933, nearly 9,000 U.S. banks failed, destroying savings for millions of depositors. The collapse demonstrated how interconnected banking systems amplify economic shocks. In response, governments introduced deposit insurance and stricter regulations. These measures reduced panic but did not fundamentally alter the incentives driving credit expansion. After World War II, the Bretton Woods system established a new global monetary framework. Currencies were pegged to the U.S. dollar, which was convertible to gold. This system provided stability for decades, but relied on disciplined monetary policy. Over time, increasing debt and spending pressures strained the arrangement. In 1971, the United States ended the dollar's convertibility to gold, effectively creating a fully fiat monetary system. This shift allowed unlimited expansion of money supply through banking systems. With fewer constraints, credit growth accelerated significantly across developed economies. Asset prices, particularly real estate and equities, began long-term upward trends. Banks benefited enormously from this expansion, earning interest on growing volumes of loans. Meanwhile, savers often experienced declining purchasing power due to inflation. Inflation acts as a hidden tax, eroding the real value of money over time. While nominal balances may grow, their actual purchasing power can decline significantly. During the 1970s, inflation in the United States peaked above 13%, reducing real wages and savings. Banks, however, adjusted interest rates and lending practices to maintain profitability. The cycle continued into the late 20th century with increasing financial innovation. Derivatives and securitization allowed banks to distribute and obscure risk. Mortgage-backed securities became a major driver of credit expansion in the early 2000s. These instruments packaged loans into tradable assets, spreading exposure across the financial system. This structure encouraged aggressive lending, including to borrowers with weak credit histories. As long as housing prices rose, the system appeared stable and profitable. By 2007, U.S. household debt had reached approximately $14 trillion, driven largely by mortgages. The system's stability depended on continuously rising asset prices. When housing prices began to fall in 2006, defaults increased rapidly. The complex web of financial products amplified losses across global markets. In 2008, the collapse of Lehman Brothers triggered a global financial crisis. Credit markets froze and economies around the world entered deep recessions. Governments responded with massive bailouts and monetary interventions. Central banks lowered interest rates to near zero and injected trillions into the financial system. These actions stabilized banks but shifted the burden to public balance sheets. Government debt surged as private losses were absorbed into the broader economy. In the United States, federal debt rose from about $9 trillion in 2007 to over $20 trillion within a decade. Similar patterns occurred across Europe and other developed regions. Quantitative easing became a central policy tool during this period. Central banks purchased financial assets to increase liquidity and support markets. This policy boosted asset prices, benefiting those who owned stocks and real estate. However, it also widened wealth inequality, as gains were concentrated among asset holders. Low interest rates encouraged further borrowing by corporations and governments. Debt levels continued to rise, increasing systemic vulnerability. By 2020, global debt had reached approximately $280 trillion, according to international financial data. This represented more than 3 times the size of the global economy. The COVID-19 pandemic accelerated these trends dramatically. Governments and central banks deployed unprecedented fiscal and monetary stimulus. In the United States alone, stimulus measures exceeded $5 trillion. Similar actions occurred worldwide, further expanding debt and money supply. While these measures prevented immediate collapse, they introduced long-term risks. Inflation began to rise as supply constraints met increased demand. By 2022, inflation in the United States reached over 9%, the highest level in 4 decades. Central banks responded by raising interest rates rapidly. Higher rates increase borrowing costs, slowing economic activity. However, they also expose weaknesses in highly leveraged systems. Banks, however, often adjust their models to maintain profitability during such transitions. They benefit from higher interest margins even as borrowers struggle. This dynamic creates a divergence between financial institutions and the broader public. While individuals face rising costs, banks adapt to preserve earnings. The structure resembles a toll system where access to money comes at a price. Regardless of economic conditions, banks collect fees and interest. Historically, this model has proven resilient despite repeated crises. Regulations change, but the core mechanisms remain intact. The European sovereign debt crisis of 2010 provides another example. Countries like Greece faced unsustainable debt levels after years of borrowing. When investors lost confidence, borrowing costs surged dramatically. Greece required multiple bailouts totaling over $260 billion. Austerity measures imposed during this period reduced public spending and economic growth. Ordinary citizens bore the brunt of the adjustment. Banks, meanwhile, were protected through restructuring and policy support. Losses were managed to prevent systemic collapse. This pattern highlights a consistent transfer of risk. Financial systems are stabilized at the cost of broader economic hardship. Currency devaluation often follows excessive debt accumulation. When confidence declines, currencies weaken, reducing purchasing power. Argentina provides a clear case of repeated currency crises. Since 1950, it has experienced multiple episodes of high inflation and devaluation. In 2001, Argentina defaulted on approximately $100 billion of debt. The peso lost significant value and inflation surged. Banks restricted withdrawals, leading to widespread protests and economic disruption. Yet, over time, the financial system was restructured and continued operating. These cycles demonstrate the persistence of underlying mechanisms. Debt expansion leads to instability, followed by intervention and reset. Modern economies remain deeply dependent on continuous credit growth. Without it, economic activity slows significantly. This dependency creates a structural incentive for ongoing borrowing. Governments, corporations, and individuals all participate in the cycle. Banks sit at the center of this system, facilitating and profiting from credit creation. Their role ensures consistent revenue streams through interest and fees. Even during downturns, policy responses often prioritize financial stability. This reinforces the position of banks within the economic hierarchy. Technological advancements have not fundamentally changed these dynamics. Digital banking and fintech operate within the same monetary framework. Cryptocurrencies introduced alternative systems but remain relatively small in scale. Traditional banking continues to dominate global finance. Central bank and digital currencies are being explored as future tools. These could further centralize control over money and credit. The core issue remains the same. Money is created as debt. The structure requires repayment with interest, ensuring continuous demand for new borrowing. Over time, this creates a compounding effect. Debt grows faster than underlying economic output. When growth slows, the imbalance becomes more visible. This often triggers financial stress and policy intervention. The cycle of expansion and contraction resembles a breathing system. However, each expansion phase tends to increase overall debt levels. This creates a long-term upward trajectory of leverage. The system becomes more sensitive to shocks over time. Interest rate changes act as a primary control mechanism. Small adjustments can have large effects on highly leveraged economies. When rates rise, debt servicing costs increase rapidly. This can lead to defaults and reduced spending. Banks manage this risk through diversification and policy support. Their structure allows them to adapt more effectively than individual borrowers. This asymmetry is a key feature of the system. It explains why banks often remain profitable even during crises. The global financial system today shows many familiar warning signs. High debt levels, rising interest rates, and slowing growth create a fragile environment. Geopolitical tensions add further uncertainty. Trade disruptions and resource constraints can amplify economic stress. Currency competition is also increasing. The dominance of the US dollar is being challenged by alternative systems. Reserve currency transitions historically involve periods of instability. These shifts can reshape global financial power. The British pound lost its reserve status in the early 20th century. This transition occurred alongside economic and geopolitical changes. The US dollar has maintained dominance since World War II. However, rising debt levels raise questions about long-term sustainability. If confidence in major currencies declines, global markets could face significant disruption. Capital flows may shift rapidly, creating volatility. Banks will continue to play a central role in navigating these changes. Their influence over credit and liquidity remains critical. The implications for individuals are complex. Savings, investments, and income are all affected by systemic dynamics. Understanding these patterns provides a clearer perspective on financial risks. It reveals how outcomes are shaped by structural forces rather than isolated events. The system is not designed to fail, but it is not designed to be equal. Its primary function is to sustain credit creation and economic activity. This creates both opportunities and vulnerabilities. Participants must navigate a landscape shaped by cycles and incentives. The final insight is not that banks are uniquely advantaged, but that the system itself is structured around their role. Recognizing this reality changes how we interpret financial success and loss.